Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, it continues to be a battle between the bulls and the bears, very close to the all-time highs. The bulls, when you needed them the most, showing up in a big way to save our daily uptrends temporarily. You can say that it's a battle of the narratives right now around the all-time highs. On one side, you have the narrative of weaker job creation in the United States, which we saw as a result of the non-farm payrolls report last Friday. Additionally, with that bearish narrative, you also have the threat and possible impacts of the tariffs on inflation, which is a short-term catalyst. On the bull side, though, we have extremely strong earnings, and don't forget, we also have $5 trillion in tax cuts, which are going to be working their way into the economy, and possibly as well, a lot of rate cuts on the horizon. So a battle of narratives right now, a battle between the bulls and the bears, but overall today, the bulls were victorious, and a lot of that movement came from some big tech names, two big tech names to be specific, that were kind of left behind last week after their earnings. And on the channel, we were saying that those names were buys at their recent lows. Those two names, of course, Apple and Amazon. Apple having one of their best days in recent memory, 5% and up another 2.5% in the after hours. We'll get into why. And Amazon here up 4% on the day. Special shout out to Tesla as well, making its way into the greenest aspects of the market today. In terms of the news that we got today, well, there were several different elements. Number one, we had Trump early this morning raising tariffs on India to over 50% total tariff rate because of the fact that they are importing Russian oil. The tariffs against India came as Trump's special envoy, Steve Witkoff, met Wednesday in Moscow with Putin, days before the White House's deadline for Russia to strike a new peace deal with Ukraine. A White House official said the meeting went well and that the Russians are eager to continue engaging with the United States. These tariffs against India, of course, are to dissuade the imports of Russian oil by foreign nations to kind of stem Russia's progress into Ukraine. In other news today, we got more tariff headlines. After hours, guys, Trump vowing 100% tariff on chips unless companies are building in the United States. Now, you would expect the impact on the markets to be somewhat negative, but actually it was not. Why? Well, simply because a lot of these companies had previously committed to building manufacturing facilities in the United States back in April and May when all of the tariffs started initially. The good news for companies like Apple is if you're building in the United States or have committed to build, without question, committed to build in the US, there will be no charge. This does include several companies such as Apple, such as NVIDIA, such as AMD, such as Taiwan, who are expanding their facilities in Arizona, and companies such as Broadcom as well. So for the most part, a lot of semiconductor companies were unaffected by today's news. But still, right, 100% is a very large headline. It's a good thing that a lot of these semiconductor players got a head start, though. And the last piece of news came early today, which was one of the reasons why Apple was up 5%. But we got even more clarity in the after hours when President Trump had a direct meeting and press conference with Tim Cook, the CEO of Apple, around 4:35 p.m. Eastern, which I did listen to. Apple and Trump detail $100 billion in U.S. spending expansion, including $2.5 billion for an iPhone glass factory. Take a look at some of the headlines right here. So the company said its US-based supply chain would produce more than 19 billion chips for its products this year. That's including chips made by TSMC in Arizona, said Apple. It also includes US-made wafers from Global Wafers and chips from Texas Instruments, all American companies. Apple said it would collaborate with Texas Instruments to install additional tools in factories in Utah and Texas. Global Foundries, a US-based foundry that manufactures older chips, especially for the US government, will manufacture wireless charging technology in New York for Apple. Apple said its goal was to have an end-to-end supply chain, which means that every part of the chip-making process can take place on American soil. So the news of that investment and the fact that Apple was heavily investing into US manufacturing led the stock to be up over 5%. Why is it up another 3% in the after hours? Well, it had to do with one question that was asked by a reporter directly to Tim Cook today in the after hours meeting between Trump and the Apple CEO himself. The reporter basically said, well, are you ever going to build the iPhones fully in the United States? And Tim Cook said, listen, we are making a lot of the individual components of the iPhone in the USA. He talked about the glass. He talked about the chips inside of the iPhone, the M chips, so the processors, right? The CPUs of the phones. He talked about several of the camera lenses. He talked about the networking components of the phone. So a lot of the phone is going to be built in the US. However, they still will be assembled abroad and then brought back. So Apple will not pay tariffs on most of the components there because they're made here. It's just that they outsource the phone to be finally assembled elsewhere and then bring it back. That will have no impact. Why is it up 3%? Well, it's because of what Trump said directly following that question. He said, "We are very pleased with Apple. Tim's been doing a great job of trying to reshore the manufacturing processes for Apple devices back to the United States, and we are very happy with that." He said that Apple has been building these products abroad for a long time, and they're finally bringing them back. And he also said this is why the stock really started to run right directly after this question in the after hour, guys. In the after hours, I mean, you can see it right here when that question was asked. It was right about here, right? He said essentially that they've been assembling them abroad. They're not manufacturing the components abroad anymore, but they've been assembling there for a long time, and that's okay. Tim said that he's going to work on that in the future, but we're very happy with what Apple is doing so far. In other words, if you read between the lines, probably that means that no further pressure will be applied against Apple by the Trump administration. They say that they are pleased with the commitments that Apple has made so far. As a result, it helps shareholders and it does help the pressure that the company's been facing a lot. So you have another 3.5% in the after hours on Apple. It was a heck of a deal, and I've been saying it on the channel, guys. You guys know that we've been loading up leap call options, some there, and now it's time to reap the benefits of those good positions. So very good day on Apple. Congratulations to all shareholders out there on Apple for the day. Those are your main news headlines for today. So in today's video, we have a lot of things to recap together. Number one, as per usual, we are going to take a look at a bunch of earnings that happened today. Very fun and interesting ones. Number one, we'll be looking at Uber, thereafter Shopify, thereafter one that's not even on this list, surprisingly, which is AirBNB. And then the final one we'll be looking at is Elf Beauty. Now, shout out to all the other interesting companies on this list: Disney, McDonald's, Duolingo, Fortinet, Symbotic, AppLovin. We will try to do as many as we can, try to catch up on these names on the Friday session. But for today, we'll do those four: Uber, Shopify, Elf Beauty, and AirBNB, of course. Thereafter, we will do our major technical analysis rundown of all our major market indexes, see how are the bulls shaping up now after the Friday drop into some recovery. Who is in control? So we'll take a look at all your major indexes and derive those areas of control and where we might be interested to position in the near-term future. Thereafter, we will do the exact same thing on this tech list right here. Go through the tacticals, derive possible locations for some swing trades or long-term positions. And that will be it for today's video, guys. For earnings, so sadly, I do not have the time to go through the biggest gainers and losers of the day. We'll kind of have to probably do that tomorrow and or Friday. Hope you guys understand. So without further ado, let's jump right into the video, shall we? The SPY up 0.77, the Q's up 1.26, and you can see in the after hours, coming up a little bit more. Taking a look at the heat map for the day, well, we've already went over it briefly, but big tech having a good day. Only Microsoft pulling back ever so slightly. Financials coming to the table and participating in a very nice fashion today. Healthcare continues to be the drag on the S&P, unfortunately. We had a good movement here by some of the defensive names. Walmart and Costco really pulling their own weight in that sector. And the bottom half of the market, a little bit mixed, right? Industrials very mixed. Real estate and energy, sadly, not performing too well. At least, though, some of the largest sectors did hold up the indexes very well. One day relative, you can see that even better. Most of your big major sectors were on the top of the board here: cyclicals, defensive, tech, communication services, and financials. Sadly, healthcare at the bottom of the list, and some of your smaller components as well. On the 1 week relative, we are still not back to positive territory after Friday's drop. For the most part, of course, but still, now it's no longer all red. You have some sectors that have regained positive territory: communication services, materials, defensives, and utilities. Sadly, technology is still in the red. Surprising, I know, but still in the red, and healthcare as well. Semiconductors have been a little bit sluggish as of lately, but still, the sector is by large and by far holding up well, especially the data center-centric components of that segment. So before we move into more technical analysis, guys, let us dive into our earnings, and we're going to start it off with a pretty interesting one, and that is going to be Uber. So Uber, a whole focus of the company was, what are they doing to address the robo-taxi concerns, the autonomous vehicle concerns that supposedly is going to disrupt their business? Are they embracing it? Are they fighting against it? What are they doing, and how's it affecting their numbers? Well, I'm happy to report, guys, Uber actually had a very strong quarter, beating EPS by 0.11, not the biggest one, beat on revenue by 1.44, but they did announce $20 billion worth of buybacks, which is almost 11% of the entire stock float outstanding. Let's move into some of the numbers. Some of the easy numbers at a first glance. Revenue up 18% year over year. Very strong. Bookings 17% year over year. Active users up 15% year over year to 180 million people. What a strong company, guys. And even EBITDA beating on the bottom line too. So not only are they scaling revenue, they're actually becoming more profitable as they do it. And you can see the EBITDA margin here steadily curling up and to the right over the course of the last roughly 8 quarters. That was not always the case for Uber. I'll remind you, a few years ago, up until 2023, profitability was a non-factor for them, right? Meaning that, well, not a non-factor, but they were just net margin negative. Ever since then, they've been able to scale into profitability and have been delivering better and better net margins so far. This quarter, 11% net margins overall. Let's take a look at some of the earnings highlights here. So Uber beats on revenue and announces that juicy $20 billion stock buyback. So mobility, 18% year over year. That's basically Uber rides. 18% gain, fantastic. Delivery, the Uber Eats segment, 20% year over year. These are really good numbers, guys. Last quarter, I'll remind you, Q1, 13% on mobility, and deliveries, 15% in Q1, right? So accelerating, as a matter of fact, when we compare with Q1. Very nice. Uber's revenue increased a total of 18%. At this point, here's what the CEO had to say. At this point, we're not seeing weakness in the consumer. Curious, another company not seeing weakness in the consumer. So we know that the consumer has been divided so far. We've been talking about it all earnings season so far. Visa, MasterCard, the bank saying the consumer is somewhat unaffected. And depending on the industry, right? Travel saying the lower income cohorts of consumers are affected, but middle class and upper class, or I shouldn't say upper class, right? I should just say the wealthier components of the consumer demographic, they're not affected. But we know everybody's being picky, right? So we know that quick service restaurants, depending which ones, McDonald's had good earnings today, but Chipotle last week did not. So it really appears to be targeted, right? Consumers are being very picky, but you cannot say broadly that the consumer is weak. We have more data showing that the consumer is actually resilient, more so than the contrary right now. This is just another company saying, no, they're not seeing it. It's steady as she goes. And for Uber, that's great news. Monthly active platform consumers increased 15%, as we already saw. In some international markets, Uber Eats' food delivery service is more popular than ride-hailing, and the company is working to increase cross-platform activity to drive sales growth. Basically cross-promoting, right? If you use Uber, the Uber rides, well, they're going to start advertising more and more Uber Eats to you. If you only use Uber Eats, they'll start advertising the ride-sharing service to you. Autonomous rides. Here is what everybody's wondering about. Uber does not break out the portion of trips or deliveries it is now conducting via autonomous vehicles, but the push into AI is now a major focus for the company. This is physical world AI, and we think it's going to be a huge trend going forward. So the CEO embracing the shift. The ride-hailing platform now has partnerships with 20 companies across the world involved in autonomous mobility, delivery, and freight services, and is offering autonomous services in 12 different cities already. Its partners range from robotaxi leaders Waymo and Apollo Go to venture-backed startups like May Mobility, Neuro, and Wave. Moving on further, it's great to see Tesla in the market, said the CEO. They're taking their time and they are making sure they're expanding in a safe way, embracing the competition. All of this competition in autonomous is going to create safer streets, and we're going to be a big part of that. Obviously, you got to read between the lines. He's basically saying, listen, Uber has such large network effects and such good partnerships with many autonomous vehicle services around the globe that there's probably going to be growth in that area for them for years to come. So it's definitely not one or the other right now, right? In terms of ride sharing versus autonomous. Actually, it's kind of a synergy of both right now for the company. Uber expanded its partnership with Waymo to Atlanta, obviously, in last June. Taking a look at some of the highlights right here, you can see that 30% of eligible mobility riders have never tried delivery. So there's still a whole segment of their own customers that they need to appeal to. 12% of delivery gross bookings generated via the Uber app. Very good. So they're trying to do more and more cross-sales, as we've been saying. Uber One, the paid service, 36 million members. That is very strong. They represent 40% of combined delivery and mobility bookings. Uber is going to seek to onboard more and more customers here. And as a matter of fact, I have Uber One myself. The savings are pretty good, and I would not be surprised if more and more people sign up for this city over time. Sorry, I skipped over the autonomous vehicle segment, but still, you guys know the deal. We've already went over the numbers a little bit in the article. So moving on further, it's a cool ride though, right? Lucid, Neuro, Uber, pretty nice. Anyways, operating metrics, monthly active paying customers, 15% year over year. Definitely no slowdown there. Monthly trips per paid customer, is that going up? Are people that are on the platform, are they using it more and more? As a matter of fact, yeah, 2% year over year. Not the biggest growth, but still, right? It's tough to have a big uptick in that number when there's so many users. And the amount of trips, 18% year over year. Fantastic growth for them. Gross bookings, 18%, right? No slowdown in this chart whatsoever. Very strong gross bookings. Revenue, very strong up and to the right, consistent as you would assume. Adjusted EBITDA, consistent. As they scale their revenue, they're getting more and more efficient and driving more money to bottom line earnings. That's exactly what you want to see. Obviously, it's coming off the highs. The growth rate is declining, but I'll remind you, they were non-profitable, right? So eventually the law of large numbers catches up and they will hit their target operating margins and target net margins. Net margin target should be between 15, high teens essentially for the company. So there is still some margins to be had by this company as they continue to scale. Mobility highlights, gross bookings for mobility, 18%, very strong. Revenue, look at this curve right here. This is your revenue margin, guys, looking very strong, expanding on that metric, and EBITDA as well, right? The company is sustaining efficiency, especially for margins. Delivery highlights, Uber Eats, how are they doing? Well, gross bookings 20%, as we said before, very strong up to the right. Revenue margins increasing as well, very strong. And here you go, your profit margins for the delivery segment getting better and better as time moves on. Everything is moving in the right direction. Freight, which is a small component for Uber, not too bad, but still, this is a segment of the company that they are scaling and still unprofitable in, but nice to see them reduce the operating losses as well from this segment too. Overall though, guys, very strong quarter for Uber. Uber is growing really well. I mean, the company's up 40% year to date already. That being said, look at the EPS, right? EPS was very inconsistent before. Now, very consistent. The company's growing well. And revenue continues to be a very strong growth driver for the company, of course. Well, their main growth driver, of course, right? So as they scale, they'll bring more and more money into free cash flow, into shareholders' pockets, which allows them to do $20 billion of buybacks. So right now, even though the stock was slightly red on the day, no reason specifically, guys. These were very good numbers. It's just they weren't a blowout, right? They beat metrics, but they didn't beat them by super wide margins like Meta and Microsoft. But it was a very solid quarter. You'd be hard-pressed to find anything wrong with Uber's earnings this time around. We just know that Wall Street's been a little bit picky with earnings, especially this season. So that being said, is Uber a buy right now at $89? Let's have a look, shall we? At $89, you're looking at a 30.47 forward price to earnings. Company's growing revenue at 12% per year for the next few years, and EPS is 26% growth for the next few years. Very solid. The PEG ratio right now, when you divide the PE by the EPS growth rate, you get a very cool PEG ratio of 1.17. That is not expensive at all for a tech company. Dare I say, Uber might just be a tad bit undervalued still, and a trailing 12-month free cash yield of 4.2%. These buybacks are definitely going to help. Company moving well in all directions, expanding revenue very quickly, all segments participating, both rides, so mobility and the delivery segment, and expansion of free cash flow, expansion of margins looking very good, and a relatively cheap valuation. So as a matter of fact, guys, Uber indeed still is a buy. It's not a full send buy for me as it kind of was back here in the $60, $70 range, but I would not be opposed to adding more Uber shares here, and especially if for some which reason we just continue this daily downtrend for XYZ reason, if the markets fall off, seasonality, right, things of that nature. If we do come back down into the low 80s, this is going to be an area where I may just contemplate some leap call options once again, but for now, just going to nibble some more shares for the long-term portfolio. That's everything I had for you guys for Uber earnings. Hopefully you enjoyed that. Now it's time to get into company number 2, which is going to be one that rallied in insane fashion today. Shopify, the company up 22% after their earnings from this morning. Let's get into it, shall we? So in terms of Shopify, guys, very strong numbers, beat by 21.5% on EPS. This is a blowout, absolute blowout by the company, and a 5% beat on revenue as well. But the kicker was basically them saying, what tariffs? Essentially, we'll get into the numbers, but that's pretty much what they said. They said, tariffs? What tariffs? We're not seeing them. So let's go have a look at the easy numbers here. Revenue up 31% year over year. The monthly recurring revenue up 9% year over year because Shopify has two different streams. Well, they have a lot of different streams of revenue, but some of them are fixed fees when you sign up for the platform. Some of them are monthly recurring fees. The subscription model, which is higher margins, of course. This was up 9%. Very good. Gross merchandise volume that ran through the platform, $88 billion through Shopify, 31% year over year. And operating income, one of the highlights, 42% year over year. Very strong recovery here in operating margins. They had a big drop last quarter as they realized some one-time items. Very strong recovery in net margins. Let's get into the article, shall we? Shopify stock sourced 21% on rosy guidance as the CFO says tariff hit did not materialize. Let's jump into it, shall we? Second quarter sales surged 31% year over year to $2.68 billion, an acceleration from a year ago when revenue expanded roughly 20%. Very strong numbers by Shopify. I love this company. I don't talk about it too much, guys, but I'm very bullish on Shopify. Always have been, and for the foreseeable future, likely always will be. The third quarter guidance, the rosy guidance in question, Shopify said that it expects revenue to grow at a mid to high 20s% rate year over year, which is higher than the 21.7% that Wall Street estimated. So mid to high 20s, you can assume 25, 26, 27, 28 type of thing, well above the guidance. So not only did they crush it on this quarter, they increased guidance by a very substantial fashion, which is why the company is up so much. The upbeat report and guidance suggested Shopify, which sells software for e-commerce businesses, is navigating Trump's trade war better than feared. Last quarter, the company noted that there were macroeconomic uncertainty ahead, but that it wasn't seeing significant price increases amongst its merchants due to the tariffs. This was last quarter. Well, here's what the CFO had to say. We had factored into our guidance some potential impact from tariffs, which did not materialize. Basically saying, what tariffs? We don't see any tariffs yet. Online retail peers Amazon and eBay last week reported strong revenue growth, indicating that consumers kept buying despite concerns about tariffs and rising prices. So another indication from the consumer here. We got it from Amazon. Here it's saying we got it from eBay, and now Shopify. There's a lot of GMV, guys. Shopify is not small, right? $88 billion of merchandise that is being sold throughout their merchant solutions, right? So you got to take it for granted when these companies say the consumer is still there. They are still there, right? So moving on further, the company hasn't seen any drops in U.S. demand, whether inbound, outbound, or local, and instead saw the market accelerate in the second quarter. Many Shopify merchants have raised prices, he added. Shoppers don't appear to be stocking up or pulling forward demand in anticipation of the tariffs. So far, we're seeing no slowdown from the tariffs, and that includes up until early August, where we are today. Very good. The millions of stores on Shopify are doing really, really well, he added. Moving on further, GMS, which is gross merchandise sales, rose 29% year over year, which is the $88 billion figure that I was showing you just a little bit earlier, surpassing the expectations of 81.5. So they blew it away, guys, by $6 billion. That's a big beat on gross merchandise volume or gross merchandise sales. Net income jumped to $906 million, which is compared to $171 the year prior. Shopify, kind of like Uber, was a company that before struggled a little bit with profit consistency. Some quarters they were profitable, some quarters they were non-profitable, but as of recently, I mean, last quarter was a bunch of one-time line items, but they're trying to be a bit more consistent. So you can see that net margin increase as opposed to a year ago. Right now, though, guys, 33.8% net margins. And if Shopify is going to be a consistent company, these are the type of net margins that you should expect from them on a recurring basis. If you take a look at some of the financials here, they have largely the gross margins to do it, right? Decent gross margins for the business that they operate in. So gross margins are there, operating margins 12, and now so far, where they're going to be trying to bring in more and more of that to the bottom line. So we'll see if they can execute properly and continuously raise those operating margins, the net margins, right, to high teens to eventually 20s, and possibly, hopefully, push it a little bit further even. Now, moving on further, the company also said it expects operating expenses as a percentage of revenue to be 38 to 39 compared to 39 to 40%, which just means as they scale revenue, are they able to control expenses? What you don't want is when a company increases revenue, the expense profile to move in line with that revenue, or higher, right? They spend more money to make the extra dollars. What you're seeing right here is a company that as it scales revenue, the expenses are actually coming down as a percentage of revenue, which is good. That's a position you want to be in. Shopify has been investing heavily in adding more AI tools to its platform as a way to attract and retain merchants. In May, the company released an AI store builder that generates web stores based on a few keywords. This is very good, guys. I've used Shopify in the past to build websites back in the day, a long time ago, like 6, 7, 8 years ago when I tried to jump on the dropshipping trend. Shopify was not the merchant solution tools. It did not have the same tools that it does today. You used to have to build, they used to provide templates, but you used to have to fill in those templates, everything yourself manually. And although it was relatively quick to build a website, call it like 2-3 hours type of thing, now you can do it in just a matter of minutes with the new AI tool builder. So I assume everybody, all the merchants looking to build a website on Shopify and use Shopify as a merchant solutions platform, I assume that people are welcoming those changes. It definitely does show up in the numbers. Moving on further, as we continue to expand our platform capabilities, add new products, and build for where commerce is heading, Shopify is becoming even more compelling to a wider range of businesses than ever before. So, not too bad of an earnings season for Shopify, guys. If we take a look at some of the earnings slides, we're not going to go through a lot of them, but just a few of them here. We're a growth company with revenue and GMV accelerating in Q2 2025. Well, I'm glad for them to say that they're a growth company. If not, who would have guessed, right? So GMV up and to the right, very solid acceleration here from Shopify. Merchant Solutions, which is your dark blue line right here, 2.7. That is 76% of all sales. Subscription Solutions as well. As I said, guys, right? There's a one-time fee for coming on Shopify and using their services sometimes. And then thereafter, they will charge you a monthly recurring subscription fee to keep your website activated. But also, they sell a bunch of add-ons, right? A bunch of metrics that merchants need. Whether you need data from who is checking out on your platform and where, or whether you want to implement different tools. There's a lot of different tools that you can do for marketing on these websites, right? Adding, different things, different add-on. When you check out, you might get a recommendation. Hey, add this to your cart. That's a tool that you can buy on Shopify to add onto your website to make the website more appealing. Shopify sells a ton of those different tools and add-ons overall. And of course, those are part of the one-time merchant solutions, but the upkeeps of the websites themselves and other features, those are monthly recurring revenue features, right? Shopify payments continue to drive higher year over year in terms of their penetration. Very, very, very strong here. This is Shopify Pay, right? So you can use whenever you're a merchant, and let's say I have a store that sells candles, and Shopify, I've built my website on Shopify. I use them kind of as the back end for my store type of thing, right? And let's just say that I also, where's the money gonna go, right? When I get paid money on my store, where do I send the money to? Do I use PayPal? Do I use Stripe? Who is the back end to pool the money before I can pay it out to myself towards my bank? Shopify started their own payment network a few years back, and it's called Shopify Payments, and it's very good. Obviously, they make some fees on that. Currency conversion fees, withdrawal fees, processing fees, small fees, but still they do charge fees. Very nice. You now have 64% of everybody using Shopify for their websites, their businesses, right? 64% of those people are now using Shopify Payments. So they're keeping everything in-house, which is very good. A lot of synergy between those two lines of businesses here. Subscription revenues continue to increase year over year, which is very strong, right? So here you have the standard revenue in blue, Shopify Plus adding a lot of features, and then you have the revenue apps, themes, domains, variable platform fees. So this is just a breakdown here of all your merchant solutions overall, delivering sustained growth and profitability. Here you can see that the gross margins are fairly stable in the high 40s to low 50 range, as gross profit tends to increase as a overall absolute number. They've reached their lowest quarterly operating expenses as a percentage of revenue ever. So this is very, very strong here, guys. Very, very strong. So this, I know it might appear a little bit awkward, but I promise you, even though it says 2024 here, I promise you this is the Q2 report from August 6th today. It's just Shopify's, their taxation year, right? Their corporate year, they're a little bit behind, right? So keep that in mind. It's not that I'm using the wrong slides. Monthly recurring revenue, 27% 5-year compound annual growth rate, which is very strong too. And overall, though, guys, everything is very strong here. Nothing bad to say. And free cash flow as well, up 18%. So those are just a few of the slides that I figured should be very important to show you guys. They're gaining more and more market share as the time moves on. And Shopify Pay continues to be a good portion of their expansion. Sorry, I'm just scrolling through to see if there's any slides that I missed here. I don't think so. The operating leverage, we talked about how they're reducing various levels of expenses, operating expenses, sales and marketing, R&D, G&A. So a lot of this coming down, giving them a more lean expense profile as they scale into revenues. All things considered, guys, fantastic quarter from Shopify. Don't need to look into it more than that. You can take a look at some of their balance sheet statements right here. You can see that overall free cash flow is good and rising. They don't have too much debt. They have a decent amount of cash on the balance sheet. So their balance sheet is quite solid in terms of future expansion for EPS and revenue. Very solid. It's getting a lot more consistent now, finally hitting that expansion curve right now for EPS over the next 4 years and hitting the revenue expansion curve as well. Very strong, guys. Look, Shopify is almost going to be doubling its revenue from 2025 through 2028, 2029. So the growth is definitely not done. They've doubled their revenue a few times in recent history, but they will be doing it again by 2028. Very, very strong numbers from this company overall. So now taking a look at their fundamentals, guys. All that being said, is Shopify a buy here at $154? They are not yet back to their former all-time highs, but still well off the April lows. They have well surpassed the 2x metric by now. Stock is up 120% from the lows. Is it a good buy now, even after the rally? Well, in terms of the valuation, it is somewhat questionable here, guys. At $150 right now, you're trading at a forward price to earnings of 102. Even though they're growing EPS at a fantastic clip of 28.5%, you are still sitting at a 3.58 peg. Shopify was a great buy down here, 60, 70, 80, 90. Even recently, when I was talking about this one at the low 100s, it was a very decent buy. At 154 right now, though, it is time to take a little bit of a pause on this stock, in my humble opinion. It is trading at a forward price to sales of 18.1, and even if you were to consider the $19 billion that they'll be bringing in 2028, if we just do some very quick math, their current market cap is 200, they'll be bringing in 19 billion by 2028. They're trading at a forward price to sales of 10 for 2028 sales, right? Right now it's an 18. Now, on average, especially when companies will hit the law of large numbers eventually, these tech companies tend to trade between a 10 to 12 when their growth rates start normalizing in terms of revenues and other things of that nature, right? So 10 to 12, I mean, you're already hitting 2028 valuations now. So sadly, if you're buying this one, you're kind of just crossing your fingers that the market will continue to sweep it higher. You're definitely not buying this one for the fundamental valuation right now, that's for sure. It's not a terrible buy. They probably will be able to grow their market cap, by 2028. But the risk-reward profile is always something that I focus a lot on the channel. And sadly, the risk-reward profile is just not attractive anymore for Shopify. However, if you are a shareholder that you've bought some shares here or here or here, then it is definitely a hold for me, right? There's always 3 recommendations: buy, hold, or sell. Well, it's definitely not a sell for me because they will be growing in the future. It might not be a buy for me, maybe a nibble to further increase our share count, but it's definitely not a full send buy for me right now. However, if for some which reason, it's going to be tough to do, but if for some which reason we retrace some of these gains in the next market correction, whenever that may be, and I can find myself at a more manageable valuation down in lower 100s, then it would become a buy once again. The last time I was saying that this one was a good proposition was really down here in the low 100s, but now it's just a little bit late in my humble opinion, but a fantastic company, all things considered. Congratulations to all Shopify shareholders out there. You guys probably have nothing to worry about, especially in terms of the next few years of the growth of the business. That is it for earnings number 2. Now let's move on to earnings number 3, which is going to be another interesting one, AirBNB. So AirBNB coming out with their earnings after the close today, and unfortunately the stock is down 6.5% in the after hours, but it was not because they had bad numbers. Matter of fact, their earnings were quite good. You'd be hard pressed to find much of anything that was wrong with AirBNB's earnings, but Wall Street has been very picky, and unless you truly blow the numbers out of the water, your stock sometimes can come down. Just look at Amazon the other week, look at Apple, look at AMD as well. Just yesterday, not bad numbers from Airbnb either. So Airbnb beat on EPS by 9.9%, almost 10, and a revenue beat by 2.2%. Let's have a look at some of the easy numbers, shall we? So Airbnb, we can see right here that their revenue was a beat indeed, as we just said prior, but revenue was up 13% year over year and earnings 20% year over year as well. Nights and experiences booked 7% year over year, gross booking value 11% year over year, and even EBITDA up 17% year over year as well. Their operating expenses were up 10%, which was lower than the amount of revenue that they generated in terms of the increases year over year. So good operating leverage as well. However, the operating expenses came in slightly higher than the estimate, and operating cash flow as well, lower than the estimate. Those are the only two slight minor things that were worse than the estimates. That was enough for Wall Street to drop the stock 6.5%, kind of exactly what we saw with AMD yesterday in a completely different segment of the market. Let's move on further, shall we? So Airbnb beats on top and bottom lines for the second quarter. Let's move into the article. Revenue increasing 13% and a net income figure of $642 million. That gave the company some net margins of 20.6%, which was okay, right? Q1 was a bad quarter for them, only 7%, but now back to normal for Airbnb, 20.6% net income margins. That is the company average of between around 15 to 20. Moving on further, in the third quarter, this is the future guidance. Airbnb expects to report revenue of about $4.06 billion, and this was marginally better than the estimate of $4.05. So a tiny beat on guidance, but a beat nevertheless. In a letter to shareholders, the company said it had a strong second quarter, even against a volatile macroeconomic backdrop, referencing the tariffs and, of course, the travel, well, it's not a travel slump. It's just people are repositioning their travel, right? Especially inbound to the United States, where Airbnb has a lot of business. Moving on further, despite global economic uncertainty early in the third quarter, travel demand picked up and nights booked on Airbnb accelerated from April to July, which is reiterating some things that we've also heard from Booking.com, another major travel operator so far. Airbnb reported 134.4 million nights, which was up 7% from a year ago, and the 134.4 nights was better than the 133 million expected. So they beat on that too. So it's hard to find, other than the expense profile, guys, which was slightly higher than expected, but still the revenue was growing faster than the expenses, right? Other than that, there's not much that was wrong with Airbnb's quarter. Gross booking value totaled $23.5 billion, which was also above the current estimate of $22.66. So another beat on gross booking value. And they announced a new share buyback program of up to $6 billion in stock, which is pretty good overall, guys. That is 7.3% of the entire stock float outstanding. So those buybacks will do wonders of supporting the share price, and they'll probably be doing more of them at these lows. During this most recent quarter, they've done $1 billion of buybacks. So nice to see them authorize another $6 billion. Free cash flow is good for the company, guys. $962 million, almost $1 billion in free cash flow for the quarter. So cash flow has never been a problem for the company. Their free cash flow yield is good at 5.3%. It's actually one of the strong points for this company overall. Now let's take a look at some of their earnings slides, shall we? So I want to highlight some of the geographic performance, right? Because a lot of the emphasis with these travel companies is, are people traveling from abroad into the United States? We know Airbnb does a lot of business there. Despite the fact they're in over 220 countries and regions, they still do a lot of business from the US. So in North America, we saw low single-digit growth in nights and seats booked overall. And a special shout out here, while travel from Canada to the US remains soft, total nights booked by Canadians both within Canada and to destinations outside of North America accelerated from Q1 2025. So travel from the Canada to the US remains soft. And international travel to the US also remained somewhat soft, but they said it has been getting better from the moment in time where they measured initially in April to the end of the measurement in July. Europe, Middle East, and Africa as well. That is not too bad, but still mid-single digit growth in nights and experiences, 9% to be specific, so better than the US. Two main growth areas for Airbnb, guys. Latin America, high teens growth for nights and experiences, very good there. And Asia Pacific as well, mid-teens growth, very, very strong growth in Latin America or Asia Pacific and Asia Pacific. So two of their best performing segments overall. If we move on to some further charts and metrics here, you'll see quarterly revenue is still net higher, which is very good for the company. Net income for the company also, as I was saying, it struggled a little bit in the previous quarter, but still, when you compare it against Q2 of 2024, which is last year, net income actually got better. In terms of the quarterly free cash flow, which is very good, you can see that it was still around $1 billion, which is standard for the company. They've been doing a really good job of being very consistent in free cash flow. As I said, it's one of the highlights for this company overall. And you can take a look at what they're doing with their share count, steadily decreasing their share count overall. So everything not doing too bad, guys. The only other highlight that I forgot to present to you guys is the number on this chart right here, which is, let me see if I can find it. Can I find it real quick? Anyways, it's the average hourly rate per night. I think I put it on a different chart. As a matter of fact, I actually did. So this is the average daily rate. So how much do you pay for an average night when booking on Airbnb? You can see here that Airbnb's, well, the blue columns right here are total nights and experiences. You can see that the Q1 is usually the best quarter. Q1 earnings for them usually measures Q4, so the winter period, right? And as the year moves on, it kind of gets a little bit softer. So it is a seasonal company in terms of when it generates most of its nights and experiences. And you can see here that the average price per night, when it's the high season, the prices are higher. And when it's the low season for travel, well, the prices are lower. But what you want to see is every year, the highs push higher and the lows are higher as well than the prior years. And that definitely is the case for Airbnb. Q2 this year, total nights is better than Q2 of last year. And the price that people are paying right now, $175 per night on average. I know some places is a lot less, some places it's more, but this is very good. This is the average daily rate. So looking quite good here on Airbnb. Nice net progression up and to the right. Overall, guys, it was a very decent quarter for Airbnb, but as I said, the expense profile was the pain point for Wall Street. Not the fact that expenses are growing out of control. They're really not. As I showed you from this presentation right here, you can see that the operating expenses were only up 10% year over year, while revenue was growing 13%. It's just that this number missed the estimates. And as a result, operating cash flow, because of those expenses, right, will also miss the estimate right there. That is they're the only two bad things about this quarterly earnings, but there are no problems with this company, in my humble opinion, whatsoever. In terms of their balance sheet is still very healthy. Not that much debt at all, a very solid amount of free cash flow, and a good amount of cash on the balance sheet as well. In terms of their EPS and revenue expansion profiles, you'll see here that although these bars are very tiny, EPS is moving up and to the right in a very nice fashion. And revenue, the highlight, of course, is also steady up and to the right as they expand their footprint and still remain one of the largest travel websites on the planet. Let's be honest, right? So over the next few years, revenue is growing 11% per year. EPS is the highlight, 19% year over year. At $120 right now, where the stock stands, is Airbnb, or rather down here, is Airbnb, a buy? As a matter of fact, yes, guys, it is. This whole 120 to 100 range is usually the range that I love playing this company, both for medium-term swing trades, talking about some longer dated call options, right? At the money, in the money, maybe leaps or something like that, or even shares, buying into the company for shares, as the valuation down here is quite manageable, right? At 120, the forward price to earnings is only a 28. When you divide that by their very nice EPS expansion, you're getting a PEG ratio of 1.47. That's not that bad for the company, and with a free cash flow yield of 5.3%, this is what really juices up the investment thesis, in my opinion. So Airbnb does remain a buy here. I think this stock is relatively undervalued, and I would not be surprised if over the next year, 2 years, the stock steadily can make its way back into the 160, 170. We know that although travel has been resilient, it definitely has not been booming for the consumer, right? But I do expect, as a lot of the tax cuts make their way into the economy, as rate cuts also allow people to have more purchasing power and stuff like that, the whole consumer discretionary segment, even though travel's been resilient, but goods and services for the consumer has been very soft in the last 2-3 years across the board, right? You can say that it's resilient, but you definitely cannot say it's a boom. This company will definitely benefit from the eventual time that the consumer does come back. And as a result, I do want to position now for that eventual recovery. Not a bad bet, in my humble opinion. That's everything I had for you guys for Airbnb. And now I'm kind of out of breath here. Now for the last earnings of the day here, guys. we're going to talk about e.l.f. Beauty. I know not all of you focus on e.l.f. Beauty, but it's been one that we have talked about a lot on the channel, especially buying it down here during the tariff lows. Those buys were very, very attractive for us. So right now that the stock is down 10.4% in the after hours, is e.l.f. still a buy here or what? So let's take a look at some of their numbers. Even though they're down 10.41, their numbers, guys, were pretty good, beating on EPS by about 6.5% and beating on revenue by about 0.5%. Let's dive into the numbers, shall we? So let's have a look right here at e.l.f. e.l.f. Beauty's profits fall 30% as China tariffs weigh on the bottom line. Some of the easy numbers real quick though, guys. Revenue up only 9% year over year. You may remember this company was growing in excess of 20% year over year comparisons, but we're comparing against very difficult numbers. The total amount that they've been growing so far is higher, but they're measuring against a very tough quarter of Q1 2025. That was a 50% year over year quarter. Now the revenue growth rate is slowing down, but the total revenue growth rate for the company on a year over year basis is still very strong. Net income, obviously, that was the highlight of the article that I just showed you. 30%, largely due to tariffs, which did have an impact on EPS as well. Moving into the rest of the article here, let's move into it. In the 3 months that ended on June 30th, e.l.f.'s net income fell to $33.3 million, down 30% from a year ago. You might think their margins got crushed from tariffs. Actually, no, 9.4% net margins. That's actually better than Q1, which saw 8.4%. The company's historical profit margins so far have been in around that. 8 to 9% is actually not bad. Their net margins used to be a little bit slimmer a few years ago, 2020 and 2021, but they've been doing a good job of maintaining them between the range of about 8-9 to 11 to 12% at the top end. So even though we declined here, it was not a bad objective number. The company, which sources about 75% of its products from China, also declined to provide a full year revenue guide. That's why it's down. The ASML effect, right? They think that they'll still be growing, but they just sandbag themselves. They're not putting any pressure on them to deliver some sort of guidance. They'll kind of take it as they go, citing the wide range of potential outcomes relating to the new duties. Now, I'll remind you in terms of the tariff rates that e.l.f. paid in Q1. They paid 145% tariffs in Q1. Now, they're paying 55%, but still a large amount, which did lead to a price increase by e.l.f. We're going to talk about it here soon. The company only issued guidance for the first half of the fiscal year. They said they're expecting sales growth to be above 9% in that first half. EBITDA margins to be about 20%, which was compared with to 23% in the first half. So sadly, margins being a little bit further compressed right here. Here's what the CEO had to say. We are operating in a very volatile macro environment. Obviously, a great deal of uncertainty on tariffs. So until we have greater resolution on what the tariff picture looks like, we didn't think it made sense to issue guidance. It's the uncertainty around the tariffs that make things more difficult. Moving on further, the company has already raised prices by $1 to offset tariff costs and is working to expand its business outside of the US and diversify its supply chain. Here's what he had to say further. We are under 55% tariffs on goods coming from China, and we've planned against that. So I'm just waiting for that other shoe to drop to see, okay, where do they really settle out? I never thought I would see a day that I'm happy to see 55% tariffs, but it's a lot better than 170%. So I think once we have that resolution, we will be in a better spot. Excluding one-time items related to stock-based compensation and other charges, e.l.f. would have seen net income of $51.3 million. So that stock-based comp eating into a little bit of their profits as well. Moving on further, over the past 4 years, e.l.f.'s sales have consistently grown in the high double digits, but that momentum has started to slow as the beauty category overall cools off following several years of outsized growth. It is not just e.l.f., guys, it's everyone. Look at Estee Lauder. I mean, you guys know already what happened to Estee Lauder, right? Look at Estee Lauder's growth. e.l.f. has been the top performing company in a very difficult segment right now. You can look at Coty brands as well. Coty, disaster right there. And even the market leader, L'Oreal, guys, also hasn't really been doing much in the past few years overall. It's been a very tough last couple of quarters, 4, 5, 6 quarters for a lot of these companies, but e.l.f. is the best performing company in terms of market share gains and revenue gains of the entire segment. So they're the best player in a tough niche right now. Moving on further here. Amin said, the CEO said that growth is expected to improve in the current quarter. He pointed out that the quarter's 9% sales growth is on top of 50% growth in the year-ago period, but acknowledged that the category at large and the state of consumer spending has been soft. Sometimes people forget just how much we've been growing, he said. The category, the state of the consumer, is still challenged. There is a lot of uncertainty with tariffs and inflation. The CEO said that Nielsen data shows the company is still taking market share and outperforming the overall category. We'll get into those metrics in just a few short moments. They also just closed their acquisition of Hailey Bieber's beauty brand Rhode, which will launch in Sephora stores in the US and Canada in September. So the benefits of e.l.f. Beauty, guys, before we get into the earnings slides right here, yeah? The benefits of e.l.f. Beauty, of course, is its business model. Essentially, it doesn't have any physical stores. It relies on social media marketing and influencers to drive sales to its brand, a strategy that's been very profitable for the company and allowing them to outperform the overall category and the better part of the last 3 to 4 years. Although the consumer is in a tight spot right now, they are trading down from what? More expensive brands, which is exactly where e.l.f. Beauty comes in. They offer the same quality of beauty products at a lower price. And if you were to go for reviews of e.l.f. Beauty across YouTube, across different social media platforms, you will see that the brand is largely loved and is currently embarking on an international expansion because of the amount of demand that they have internationally. They're currently expanding into Canada, into the UK, and several end markets into Europe as well. So the future is definitely bright for e.l.f. Beauty, and they are perfectly positioned right now for the end consumer that is looking for quality products, but at an affordable price. You may remember that they raised the price on their products by $1. That's fine. A lot of their retail products retail for well under what other brands are priced at as well. Let's say a competing lip gloss or an eyeshadow or things of that nature would retail between $20 to $30 in other brands. e.l.f. is able to sell them for $7 to $10. So increasing the price by $1 is definitely not going to make the consumer pivot away from the brand, right? So the company does have a little bit of pricing power just because of the segment that it operates in. This is still the fastest selling brand across the different locations in which it chooses to list its products, namely Amazon, Target, and Walmart as well. And even in the dollar stores, it's performing very well. 26 consecutive quarters of net sales growth, but you can clearly see a slowdown here in the past couple of quarters to where they're not growing like they used to, but I think there's still a lot of growth for this business ahead. It is definitely not done growing, but it will be a little bit choppy here as they move through the tariff headlines here. One of one cosmetic brands out of 988 to gain market share for 26 consecutive quarters. Total market share for e.l.f. across various segments, guys, 14%. This is from Nielsen data, which compiles all of those different ratings, right? Moving on further, Q1 progress, we can see this today. We've already seen some of these numbers, but in terms of unit share, number one in terms of unit sales across all categories. In terms of dollar share, they're number two. So they're gaining, guys. They're gaining across the competition. The brand is growing. You may not see it in the revenue sales right now, but the whole segment is soft. This is the best performing company in a soft segment right now, right? So the comparison, right? You're looking at e.l.f. Cosmetics, the average product sale price, $6.50. Top mass brands, $9.50, and prestige brands, $20. Their price point is definitely favoring the current economic landscape that we're currently in right now. Very, very strong here, guys. That $1 price increase will be coming in, well, it already came in August the 1st. And what are people saying about this? Well, obviously, they're going to highlight the people that are, willing to accept the price increases here. So you have a bunch of, different Instagram posts that they're accepting, but still 75% of all e.l.f. products, even with the $1 increase, are still $10 and under. So really targeting that budget conscious consumer. And the fact that they're marketing more to millennials and Gen Z and under, that is their new target demographic. It's a demographic that's going to stay with them for a very long time still to come, right? Target. This is the amount in Target, the store, right? Number one in Target, 21% of all sales of beauty products, right? Walmart as well, guys. Very, very strong here. 140 basis points of increases in market share for Walmart's as well. Drugstores, 110. Groceries, 200 basis. This is all market share gains. Looking extremely strong. Dollar General, they're really starting to get all of the money in Dollar General. They're in 80% of all Dollar General stores. Very strong. right? 53% of shoppers new to ELF, which are buying in the dollar stores. Very, very strong overall here, guys, right? Here's some comparisons about the differences of their brands, right? So comparing the price points of this company to other different brands. We're not going to spend too much time on this, but all I wanted to show you guys is the market share gains. This is what counts. This is what's going to drive revenue into the future, right? It's all good if you can be fashionable and trendy for one period of time, but fall off the next. The market share gains is where this company is truly accelerating here. Face products, 22% of all dollar share in beauty. That's a lot, guys. And it's a very small company right now in terms of lip products, right? 13%, and eyes. ELF obviously standing for eyes, lips, and face. Sorry, I laugh when I say this because many people, some guy in my Discord said, I've been in ELF for so long and I just now realized that it stands for eyes, lips, and face. Anyways, so basically they're disrupting marketing engine, right? A lot of different campaigns that they run. Okay, so you guys get the point, right? It's all about the market share gains, and I think ELF will continue to deliver. People think that because of the share price, ELF Beauty is a very large company right now. It's actually not, guys. The company is a $6 billion company only, trading at a relatively fair valuation. So let's take a look at their profile here. Revenue growth is still going to be 13% per year. EPS growth is still 18% per year. Very, very, very solid. We just saw their very strong sales across Walmart, but also in Target and Ulta Beauty. And also very strong sales on Amazon. Extremely strong sales on Amazon. And that is a long runway of growth for the company too. At $100, is the stock a buy? Even in spite of the temporary problems with tariffs, I still do think so. Forward price to earnings is 27.4. The PEG ratio is 1.52. That's pretty good. Not as good as we got it down here, but still, I would not mind adding some shares of ELF Beauty at the $100 mark, especially into this beautiful area of pullback, technical support. All of your moving averages are there as well. Price to sales, one of the better metrics for the company, 3.8. Its company is cheap, guys. It's $6.26 billion market cap company right now. And the sales pipeline is growing and growing and growing. In the next few years, it'll be a $2 billion per year sales company, right? That'll be a 3. I still think this company has a long way to go, guys. When you compare it against Estee Lauder, right? Compare it against Estee Lauder. This company is a $32 billion market cap. Even after falling off a cliff, it is still worth $32 billion on a dwindling sales profile. So I still do truly think, guys, that ELF Beauty has a lot of runway ahead of it. I would not be surprised if in the future, this company is a 10, 15, maybe even $20 billion beauty company. It definitely has the runway to do it. It has the products to do it. It has the marketing strategy to do it. And overall, people tend to like the brand overall, which is very important. Brand perception, especially in cosmetics, is extremely important. And ELF is very conscious about that. That wraps up all our earnings for today, guys. Hopefully you enjoyed. Now, let's jump into some charts, shall we? Okay, so starting off with the SPY, you guys remember when I was comparing and contrasting the differences in the market environment pre-Friday and post-Friday. These bearish catalysts have not been removed, but until they materialize, the bulls still retain their control, and the control is also in the price action as well, as you guys can clearly see. We hunted the daily higher lows, but did not break them. We've been watching for the potential of a rollover, but no more bad news, no further price rollovers. I'll remind you, this market is driven on earnings. It can be driven by sentiment and narrative sometimes, but not all the times. We've just had a very strong earnings season, guys, both on EPS and by revenue. I showed you these statistics earlier on in the week. Around 80% of all companies were beating their revenue estimates, and almost 80% of companies as well were beating on their earnings per share estimates. Very strong and reiterating their end of year guidance for the most part. Certain companies pulling their 2025 guidance, such as ELF Beauty, but a lot of the biggest companies, the banks, the credit card companies, the travel companies, some of the big tech companies as well, either reiterating their end of year guidance or raising end of year guidance. Definitely not a recessionary scenario in my humble opinion. Now, that being said, the price action is very clear right now. The bears had one shot at rolling over this 4-hour trend. It has now been brought back to bullish control. 4-hour uptrend is recaptured. And if you take a look at the size of this pullback, is when you have a pullback, guys, if you want to see the bears convert, they don't want to give back too much ground for the bulls because it takes too much money to drop it thereafter, which is why you use the fib sometimes. So if you take a look at the fibs right here, over a 618 retracement. Over a 618 retracement gives the bulls the best chances of either a V-shape or a two-step recovery process. If the bears wanted to keep flushing this, you need to keep it under 50% and then make your way to the downside, and especially keep a hold of those smaller term timeframes, something we didn't have. So it's a battle, right? It's a battle. I'm not saying the bulls have 100% probabilities of doing this, but as we move higher and higher, the odds of them getting this or the two-step increase higher and higher. So the door is still open. It's still anybody's game. We are reclaiming the 12 EMA. We'll see what happens, but the clearest time frame of them all has always been the weekly. And I was very clear on this, guys. It is a weekly uptrend. We're just looking for a weekly higher low. Still no candle close above or below. So this is an inside candle. You can't really determine any of that. And if we fall a bit further, you're going further into weekly consolidation. You will have your new daily downtrend established. If we just move higher, right? Well, then, of course, this is just going to be a bit of consolidation before establishing the new higher low and higher highs. The bulls have never lost control. If we move a bit lower, though, 612 down to 596. Prior resistance highs, current support lows. Keep an eye and watch out for that, especially if you move into some form of seasonality. Keep in mind, when I bring up seasonality, guys, right? This is the average of the last 20 years. It does not mean every single August, September, and October have to be bad. It just means that on average, some months are positive, some months are negative. But you do have some positive months in here, which is why we're roughly flat, right? So keep that in mind. It's not the end all be all. And as I obviously previously showed you earlier on in the week, who is sitting here with a lot of money to buy the dip? Well, big money is sitting here with a lot of money to buy the dip, guys. And you would expect them to kind of come to play right here. They got a lot of money, institutional. Retail kind of got spooked with the jobs numbers. They still have some buying power, but they were kind of overbought. Institutions have a lot of money, and they, for the most part, were probably waiting for earnings because they move on fundamentals. Retail largely moves on sentiment, right? But the institutions buy off of fundamentals. And if you reiterate your fundamentals, especially with this earnings season that we had, probably a lot of this dip buying has been done by the institutions, by the big money. So keep all that in mind when you're factoring in your analysis, right? Moving on to the Qs right now. Qs, same concept. Very nice bounce for the bulls, back above the 12 EMA. Still anybody's game right now, but if you look at the retracement size right now from the lows of Friday, let me just expand it for you. Not too bad right now. Also a 618 retracement. It gives the bulls a very good chance of either the V-shape or the two-step recovery process, right? Because now the bears have lost momentum. It's going to take them a lot of money or some really bad news to really flush that level again. But the door is still open. In the event that they open that door and do the flush, well, then you're just heading for a weekly higher low. At this point, anything above 523, weekly higher low in a very nice weekly uptrend. And the support levels below stay planted, 537 down to 512. Keep that in mind. On to financials right now. Financials with a good day in the markets overall, but very wide area of consolidation, right? Where usually when you see an expansion, right, something like this, just very, very volatile price action right now. Tough to derive the end conclusion. But one of the clearer timeframes here, because obviously this was a daily downtrend, engulfing move, back engulfing move for the bears right now. So you're looking for the bulls to make some progress. But look at the size of this bounce compared to the Qs, right? Size of this bounce is still anybody's game. 38% bounce. So this is still a sector that is prone to a rollover. We will see if they get it or not, but we got a lot of weekly support that we're into right now, guys. A lot of weekly support, talking about 52 down to 50. We will see. Can we protect these lows and the 12 EMA and possibly just move into some sideways action and expansion? Well, it is open right now, but if it does not manifest and financials take a turn for the worst, well, what are we looking for on the largest time frame of them all, the monthly? Consolidation range. It's a very wide bull flag right now above the 12. You're just looking for a monthly higher low for possible further expansion. And hopefully you guys were taking the hint from Visa and MasterCard yesterday. Fantastic buys. Visa and MasterCard starting to uptick, right? Very strong right now, guys. Into the 200 EMA, into support for Visa. MasterCard, not so much. It did not pull lower, but Visa and American Express, some of my favorite buys right now, close to the 200 EMA, close to relevant support areas. Not bad positions, in my humble opinion. Moving on to XLV Healthcare, down 1.5%. The struggles of healthcare do continue at this point. Pay special attention to this 130 flat mark. The daily is all over the place. It's very choppy. We have big earnings coming up, guys. Big earnings from Eli Lilly tomorrow. And with that, that'll probably wrap up the biggest healthcare providers of them all. Hopefully, healthcare will be able to make a move in either direction after that. But if you lose this 130 on the weekly, guys, Weekly downtrend, and sadly, the monthly lows are not established. You'll be looking for a bit more. But look, we got a bunch of support. That's why it's been so choppy here. Why has it been so choppy here? You're around several historical things. A very large support area and a historical area such as an EMA, the 50 EMA on the monthly, which has been very tough for the bears to break and hold below for an extended period of time. So clearly it is still anybody's game, but I will be adding to my leap call position in this area. Monthly downtrend, this is diverging from the SPY in a wild fashion. The healthcare sector has been the cheapest that it's been in years and years and years and years. And I do still think it's a buy, but it needs to be a buy with patience. We are not expecting an overnight recovery, but we are expecting the sector to start moving back in line with the S&P into the end of this year and maybe into 2026, which is why I have so much time on my call options. Moving on to SMH right now, semiconductors down 0.17, but up 0.9 in the after hours after that Trump and Tim Cook speech together here. So we will see. Obviously, we knew that we lost the daily uptrend. The bulls are trying to get it back. If we close above 290, that is a recapture of the daily uptrend instantly and already puts an end to some of this weekly consolidation. It's been flat for arguably the past 3 weeks. Sideways consolidation is consolidation. I'll remind you, when you're looking for consolidation, it doesn't necessarily need to be big drops. Sometimes it can move sideways. The reason that SMH is moving sideways, but SOXX is moving a little bit more to the downside is a question of allocation. SMH has most of its weighting in the stocks that have performed the best in semiconductors for the past month. The top ones, NVIDIA, Broadcom, AMD. But look at all the other semiconductor players here on this list, guys. A lot of them are down double digits. SOXX is more balanced. As a result, because it's more balanced and not so top heavy in those data center plays, it's been pulling back more. But even this one is into support 235 to 214. Essentially what I'm trying to say here, whether you look at SMH or SOXX, you are looking to buy the dip on some of your favorite companies. So companies like Micron, especially in a support right now, companies like ASML, which is not even in the S&P, but it is in those two semiconductor ETFs. This is also a great buy. It's been out of favor recently. And even a company like AMD, which had earnings yesterday, we were saying on the channel, it is indeed a buy. So all dips are currently buys for a lot of your favorite semiconductor companies right now. So please keep that in mind. And lastly, the Russell. The Russell down today, as a matter of fact, 0.13%. The bear is still in control right now, trying to get a nice pump here by the bulls. So how much have they retraced? 618. So they do have a chance of either the V-shape or the two-step recovery process. If they can't get it done, we got support down here below 216 to 208. The Russell is still a very challenging trade, especially without very clearly defined rate cuts or a more accelerated rate cut path. I think growth stocks will do well, but they might only hit peak rally mode, maybe end of the year into 2026. It's not a bad time to position into small cap and mid cap growth right now, but your timeline has to be in a question of not weeks, but maybe months, talking about the next 3, 6, 9, 12 months type of thing for you to really get the lift that you deserve on your small and mid cap growth names, right? Talking about the VIX right now, 6%. And we were talking about this the last few days, right? Unless you have sustained volatility catalysts back to back to back to back and an acceleration of the bearish narrative, the VIX will have a pop on the bad news, surprise everybody, and then just kind of give it all back. And that's exactly what happened. The next volatility catalyst is next week when we get CPI. As of right now, still back to, I would say the averages since the month of June. So the VIX, the pop, and the drop, and now sadly fading. So hopefully all you VIX traders that were kind of building in here, hopefully you took some profits on that one-day event. Because if you didn't, guys, you're going to need to wait for the next volatility catalyst, maybe CPI next week. Talking about the yields right now, yields, I mean, they popped today, but then they dropped. There was a decent bond auction, but I think it's clear what they're trying to go for here. Trying to go for the weekly downtrend on the 10 and trying to go as well for the weekly downtrend on the 20, but it's been very sticky here. You'll see that it hasn't been easy for them to break this area, has it? Not at all, especially in the last 6, 7, 8, 9 months right now, essentially since the month of November on the 10 and earlier here in April on the 20. You need to see the flush here below to really start getting the yields down. In my opinion, they may just stay planted until traders get a better idea of what Powell is going to do in September, because the odds are 90% right now. I mean, if you look here, right? If you look at the rate cut odds now for September with the jobs data, categorically speaking, there probably will be a rate cut. The Fed usually does what the market expects of it. 93% chance odds of a rate cut in September. But people will be curious about the path. Keep in mind, in September, we get a summary of economic projections. the Fed will outlay its projections for rates, inflation, and the economy for the next 3, 6, 12 months, and even years. If we see an acceleration in the overall rate cut path, that is when you might see a more substantial drop, because now they've already priced in September. Now it's a question of how fast will the other ones come, right? Moving into further here, we're going to tackle gold. So gold on the day, I mean, not too bad of a day, but I'm looking, guys, for a possible entry here. 33.50, 33.40. There might be a nice pocket here to pull back. Why? Well, because look, I mean, you have an engulfing move by the bears right here, backtesting support. Now the bulls putting in a good move. The bulls are looking to go for it here. Look at this move on the fibs. This is a 618, almost 70 plus retracement. When that's the case, the bulls are favored for a trend change, either V-shape or the two-step process. So far, it looks like they want to go for the two-step process. Why? They've been rejecting from resistance for the last couple of days. 34 down to 33.70. If I can find a mid-30s pullback, or mid 33.40, 33.50 pullback here, there may be a trade entry opportunity whereby for a longer duration, you would put a stop loss below this low, and then you would be targeting expansion to the all-time highs. It would be a favorable trade profile here if we get a 33.40 entry with a stop loss there and a take profit at your all-time highs. 35, it's almost a 2-to-1 trade. The trade is going to take several days, maybe several weeks to play out. Not too bad. The reason that we are biased to the long side right now is the weekly. The weekly is a bull flag. It has never broken below the 12. The bulls are tightening up here at the top. So you do tend to have a bullish leaning bias for any trade setups. Keep that in mind if you are looking to position in gold. On to Bitcoin right now. Bitcoin, not with the worst day in the books right now, but still under resistance, right? 116, let's call it 116.8, 117. Clear support. Flushed it. Now it's going to be acting as resistance a little bit. So if we backtest and drop a little bit more on Bitcoin, it's always a possibility. You might just be looking for a further slide of a weekly consolidation move, but the bulls are in control. Anything above 98, looking for a weekly higher low for further trend continuation. It's been fun to sell puts down here, guys. If you've been active, you can sell puts on BITX, IBIT down here into support in the event that you would not mind being assigned down there. The bulls are in full control of this chart. Not looking too bad at all. It's just the short-term price action is temporarily in bearish control. We will see if the bulls can get that back over time with the rest of the markets. That's everything for your overall market rundown. Now let's dive into some of the big tech names, shall we? Okay, so moving into Apple, the one name that really ruled them all today, essentially, guys, 5% in regular trading and another 3% in the after hours. Right now, we are sitting at about 220 into resistance. Again, Apple will be challenging this infamous resistance zone, which stops at about 232, which was prior support all the way back there from 2024 into early 2025. The weekly is looking great. Absolutely fantastic here. Nice demand zone that will be created with this week, guys. They tested the lows after earnings. It was indeed a buy. We commented on it several times during the channel. At 219, is it too late to position? Well, it depends what your profit target is, right? Our profit targets here are about 250 to 260 all-time highs, but not right away. This is a longer duration swing trade. You are looking for the monthly upswing on Apple. After being out of favor, they probably will have a good chance of coming back, but since it's a monthly time frame, it will probably take several months to do so. So depending on your time frame, it is not too late. If it's for a short-term swing trade, then this is a take profit zone. Short-term swing trades, as we were saying, we're down here to up here. This is the take profit territory. You are into resistance, but longer term, there's still a lot of meat left on this trade, in my humble opinion. The stop loss for an entry right here would be below your weekly lows, and the take profit needs to be some of your prior all-time highs. Still a 2-to-1 setup, in my humble opinion. Apple not looking too bad, and I'm very excited for the rollout of the iPhone 17. Seems to be very bullish in terms of the reception for the iPhone 17 recently. We know that they've been improving revenue over the course of the past quarter, the best revenue that they've had in the last 3 years, arguably. Let's see if they're able to continue that into Q3 and Q4 with the new release of the iPhone. In my opinion, they probably will. So Apple, the underdog, the one that is still down year to date, guys, 14, 15%. And I was saying it's going to catch up eventually. And right now seems to be the start of that catch up phase. On to AMD. So AMD 6.42% to the downside here. I know what you guys are asking. Is this a buy? Yes, it's a buy. I said that yesterday after earnings. Daily downtrend, which is fine. You know that daily downtrend is just seeking for weekly consolidation out of resistance right now, which is 185 down to 171. We're just looking for a weekly higher low. And even if the downtrend continues, a little bit here. You got a lot of support here, 150 down to 132. So I am currently selling put options down here, but also depending on your time horizon, let's call it 2027, it's not a bad time to be building some leaps or some leap call debit spreads, but you need to have a long time horizon. We're not talking about a very quick 2x here. No, we're talking about the expansion, as I said yesterday during earnings, the expansion of the pricing power, the expansion of EPS, of margins, and revenue over the next 2 to 3 years. So AMD's best quarters are still ahead of it, and the valuation right now definitely does support some further expansion. I did the valuation at 150, where I wrote some puts today. If we get down there, it's very juicy, but even at 164, it's not all that bad. We did a lot of that yesterday on earnings. Even here, guys, it's really not that bad of a deal. Moving on to Amazon right now, Amazon up 4%. It was just a question of time for this one as well. Now, we did lose the daily uptrend after their earnings. We found some, some buyers down here, even though we were kind of in the middle of nowhere. But we're not in the middle of nowhere. It was a temporary level, not the strongest one, not as strong as down here, but a temporary level. It reacted indeed. Now the bulls have to do two key things. Number one, get through this resistance area, possibly 227 down to 218 is that resistance range. You can see they grinded their way through it recently. We'll see if momentum carries them through it over the next few days. So you'll want to see one of two things happen. Either let's look at the fibs, right? Whenever you lose a trend, you want to get it back. Look at the size of the bounce. So far, not a 50% bounce. You want to see Amazon come to the top end of resistance here, 228, to give themselves the best chance of either the V shape or the two-step recovery process. In the event the markets go red tomorrow into Friday and into next week, sadly, you're going to reject from resistance, go to lower lows, and that's going to open up even better opportunities for Amazon, guys. I was clearly saying this is a buying opportunity for Amazon. If we do move lower as a result of more weekly consolidation and we move lower into 210, 208, again, I'll be selling puts again in the lower 200 areas and also loading up more shares for the long-term portfolio. The valuation is still very manageable. Amazon is doing great things. We covered their earnings last week. There's nothing wrong with this company at all. Still one of my favorites. Moving on to Google right now, another stock that was performing well today, 0.82% to the upside. Google bulls have been defending the heck out of this resistance range, guys. 194 to 187. Very tight. You had the breakdown on the daily, full V-shaped recovery right now. The weekly time frame, they're looking to hold. If they hold, they can expand here all the way up to the all-time highs, 208 up to 201. Google looking very good in terms of price action. The bulls are in full control right now and a lot of support, as I said, below. So it's going to be tough for the bears to get through this one. In terms of the valuation at 190, if you feel that you're late, you might be mistaken. The valuation is still very, very attractive at 190, but I know what a lot of you guys are thinking. What happens about the DOJ ruling coming in August? This is true, but keep in mind, Google will probably appeal that ruling for a very long time, right? So I don't think it's going to be a material factor for the company anytime soon. It'll provide some short-term volatility, of course, that's for sure. And if we do get that volatility and it sends us back down to the 180s, you guys know the drill. It is a buy from me, and I will be adding to my leap call positions. I'm not adding to them now. The last time I bought some was down here at 165, and I did also alert that on the channel. So hopefully you guys are up some decent money right now. On to Meta. Meta up 1.12%, protecting their all-time high push after earnings. We'll see if they can get it done. One thing's for sure, though. If they clear the all-time highs, we're going straight to $800. That's the next psychological level and continuation of the daily uptrend. If we break this guy right here, 746, daily downtrend unwinding, and you might just go down to the gap fill territory, 720. This area would be another buy for me. Meta's looking very strong right now, but it's a battle between the bulls and the bears at these local highs, and he moves lower. I'll remind you, why is it a buy here? Because you're just looking for a weekly higher low, right? Beautiful weekly uptrend. Just looking for a weekly higher low for possible further trend continuation. Meta's valuation at 760. We did it after earnings. It's not that bad. Meta is a buy for me right here. If you have a next 3, 5, 10-year time horizon for a long-term portfolio, for swing trades, it's not so obvious, but for the long term, it is definitely obvious for me. Moving on to Microsoft now. Microsoft down 0.53%. You will watch if they break 521. Break 521, first daily downtrend set, and you are going to challenge this 12 EMA. If they lose both, daily downtrend and the loss of the 12, you're going into weekly consolidation. And after a million weeks of upside in a row on Microsoft and overbought conditions, it's not NVIDIA. Microsoft doesn't usually stay this overbought for very long. Usually it also does not pull this far away from the 12 EMA on the monthly. You can see every time it does, it pulls back for XYZ reason, right? Pulls back close to it, pulls back close to it. So Eventually, we will be looking for a pullback on Microsoft. We'll see if it's sooner or later, but eventually you will be looking for that consolidation. And just keep an eye on it, right? Microsoft for me right now is nothing. It's not a swing trade. We're very extended, but it's also not really a long-term portfolio add either. It's at the top end of their range. I'll wait for some consolidation maybe to derive some trades. Moving on to Netflix right now. Netflix up 2.67%. Strong day for Netflix, but still under resistance. 12.15 down to 11.85. Support, resistance for the company right now. A couple legs down of daily downtrends right here. The most recent leg is this little guy right here. It's very small, but they've engulfed it. We will see. Can they turn this around with a favorable MACD cross on the RSI curling to the upside, showing some momentum? Maybe. And if they do reset the daily uptrend, your weekly lows are set. And then, guys, you'll have to reset the weekly uptrend as well because we've lost it. This is the higher low. You lost the uptrend, but you did not set a downtrend. You are in between right now. You are trendless. This is not an uptrend. It's also not a downtrend. So first things first, the bulls need to recapture the daily. Then the weekly bulls need to recapture the weekly time frame. And only then will you know that is the end of monthly consolidation. And you may just be due for consecutive months of rally. So keep that in mind for Netflix. If that does not happen and we continue unwinding because the bears are in control right now, you might just be heading down here. $1,000, $1,100. That would be my next buying location for Netflix personally. Moving on to NVIDIA right now. NVIDIA up 0.65%. Still consolidation at the highs right now. Pay special attention to 171. Lose this, you lose the daily uptrend and you lose the 12 EMA. That'll be synonymous with weekly consolidation, which people are maybe expecting. But until the bears actually do it, right, it's not here yet. So the shorts are a bit tough right now. If we just keep pushing to the upside, well, you know the targets. Psychological targets, 190 and then 200. Now, it is somewhat extended on the daily RSI. It is somewhat extended on the weekly RSI as well. However, until you get the trend change, who is in control? The bulls, right? Very clear, very obvious right now. In around 180 is NVIDIA buy right now. Debatable. The risk-reward trade-off is not the best, but it's also not that expensive. I'd be a big fan in the event that we do get some market consolidation overall. I'd be a big fan of buying NVIDIA, maybe a bit lower here, 160, 150, high 140s. I'm not saying it's going to get there. I'm just saying, where could I establish a more clean setup for trades and longer term positioning? On to Tesla right now. Tesla up a nice 3.62%. We were talking about this the last few days, right? Tesla's very choppy, but there was a trade opportunity here in the last few days, right? Just because it's a weekly tightening range. When they tighten up like this and test the support level to 300 to 260, there's a trade here. The stop loss goes below the weekly low. You're looking for the uptrend into resistance. 341 up to 360. We will see if the bulls can expand and attack that resistance range overall. Price action is not looking too bad, but as of right now, still, I mean, you can have a tighter stop loss at this rate. Stop can go below there, and the take profit is still up here into resistance, 340, 350. It's not as good as a risk reward as it was yesterday, but it's still not all that bad, right? You know, I guess it's okay. It's kind of a one-to-one. Sorry, I thought it was better than that just looking at the chart. I guess it's not all that favorable, but you guys know the drill, right? Not too bad overall for Tesla, but we'll see. Tesla's facing a lot of short-term negatives right now in terms of their earnings. So I don't know if they have it in the tank to really start pushing again like they did earlier this year towards the 400s. We will see, though. It all starts with capturing one level at a time. On to Palantir right now. Palantir up 3.62% after their beautiful earnings yesterday. Palantir continues to be a cult stock. Let's just say it for what it is, right? Nobody wants to sell. Everybody wants to buy. So the equilibrium is definitely still tilted towards the bulls. That being said, everything is overbought right now. The RSI is overbought. The valuation is overbought. But nobody cares, and that is okay, right? Momentum is definitely one style of trading. A lot of people are holding this one for the long term, for the expansion of the market cap. They don't care about short-term valuation, they say. They just want the expansion of the market cap for Palantir down the road, which indeed is possible. But the further and further you get up here, the less favorable your overall risk-to-reward trade-off becomes, right? So that being said, the bulls are still in full control. There's just nothing other to say on Palantir. The bulls are categorically in control of everything right now. If you do see a pullback, you're looking for a higher low, anything above 151, higher low for maybe further trend expansion. On the weekly time frame, in the event that you lose the daily, right? I'll just remind you of the kind of like Microsoft, right? When you lose the daily, that is only the reason that you're going to go into weekly consolidation, and maybe the targets might be back down to 150 psychological. We will see if that does happen, but for now, there is no real entries here, guys, for short-term swing trades, unless you have the only opportunity is here for a very long-term thesis, right? On to SOFI right now. SOFI down about 0.37. Still a battle for SOFI. We're still on the watch for the loss of 20.61. If you flush this area, that's a daily downtrend and a clear loss of the 12. They're battling right now, trying to hold on to the short-term momentum. If you flush that area, you're going into further weekly consolidation, might see a tap of the 12 EMA in the 18s. Matter of fact, this is where I will be interested personally to continuously sell some puts and maybe load up for some more momentum swing trades. Overhead resistance stays planted right now, 22.56, 24.41. SOFI for a longer-term time frame, we said it after earnings, it is still a buy up here. Okay, and a buy all throughout the consolidation because the further expansion of the addressable market and the expansion of the market cap is a very real case scenario for SOFI, so it is still looking good. But short-term trades right here into resistance, a little bit challenging, but this one definitely is a hold for me. Moving on to Uber right now. Uber down. Well, we just covered their earnings, right? The stock was down a little bit during their earnings today. So that being said, guys, in the event that we cannot clear this resistance, which is 92 down to 90, the bears are still in short-term control. If we go back down lower, we are heading into further weekly consolidation. And I'm a big fan. There was some opportunities today all morning to sell some puts down here. I told you guys to watch out for this one as well. 83 down to 80 bucks is a very nice target range. Long-term, Uber is still a buy in my humble opinion. Just swing trades from here. You got to be a little bit careful, right? We are riding the 12 EMA on the weekly. This is true. There could be some nice expansion here overall, but it's a bit dicey, right? It's a bit dicey because, I mean, you have to, if you do it with a very tight stop loss. Stop loss has to go below there, and you're targeting the overhead expansion right there, just as a higher low on the weekly. Because if this is not the higher low, well, then you're going to move a lot lower and it invalidates the short-term trade setup. So keep that in mind. Lastly, TSM down about 0.47, but up 2.65 in the after hours. Loss of the daily uptrend. We'll see. Can the bulls get it back? It all starts with the size of the bounce. We will see. It looks good in the after hours right now. Overall, though, guys, it's going to be a toss-up into tomorrow. One thing is clear, though. What we were trying to do, we were trying to establish a weekly higher low. Now, I was saying at the limit, you might come down here to 221 prior highs and the 12 EMA. So far, the bulls are holding up very well, though. So swing trades for TSM right now, a little bit tough because the price action is a little bit off. Swing trades, it has to be very short-term, short-sighted, right? If we start off the morning there, you have a clear stop loss area. You are trying to say as a bull that this is your weekly higher low, consolidation is finished, and that you're going higher. So as a result, the stop needs to be there. If not, that is not the weekly higher low, and you're heading lower to try and find it, right? So that is how you try and trade these short-term time frames with a thesis. But in terms of long-term thesis, it's very clear for TSM. Super strong numbers at 237 right now. The valuation is still very manageable. Still a time to be adding shares to your long-term. When I say long-term, I mean 3-5+ year outlook. The valuation of the company is still very fair. So you haven't got much pullback, but I have been saying, even though it's at all-time highs, it is still a buy, whereas other companies are somewhat questionable when they come to all-time high valuations, right? TSM is not, still very good numbers. And with that, that wraps up today's video. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. Would love to have you back. We do these every Monday to Friday after the close. And last but not least, if you have any questions, please feel free to leave them down below in the comments. Always love reading your guys' comments and helping you guys out with whatever you ask me. And lastly, if you guys were looking to join a trading and investing community, you might consider joining ours. The link is down below in the video description. In the community, you get access to a few things. Number one, you get access to all of my trades in real time, whether those are the wheel trades, the other directional trades like debit spreads, leap call options, swing trades with shares, some of the lottery trades that I take for earnings or otherwise sometimes. You get access to all these trades. These are just some of the trades made in the last 2-3 months, something like that, right? All the green check marks are wins. All the red little circles here are losses. So you get access to all these trades, all the different types of trades. You get access to our private morning live streams. Every morning for about 2 to 3 hours, I stream live, I trade live, and I take all your questions on your stocks, your options, and your long-term portfolios. Additionally, if you're not there, they are recorded. You can also ask me your questions in our chat rooms throughout the day. I'm very fast to answer you. And additionally, you get access to our private education section where I go through many different trading strategies that I do not feature on YouTube, technical analysis tutorials, fundamental analysis tutorials, many other educational videos, guys, that I don't put so much on YouTube, reserved for our members. And you also get access to all my charts. You can copy paste all of my charts whenever you see support, resistance levels, stuff like that, or earnings annotations. You just get to copy paste all my charts. It takes 10 seconds, they become yours, and you get to copy all of my watch lists as well too, just an added benefit for the members, and a lot of other things included too, guys. But if any of that interests you, the link is down below. I would love to see you guys in the community. If you want to, increase your proficiency in investing or trading, we'd love to see you in there. And if not, well, I guess I'll see you back here on the channel. Take care. That's it for me. Have a wonderful evening. See you tomorrow. Peace.